Hello, I'm Shane Ruffing. Thanks for your interest in the disability filter. Purchasing a disability insurance policy is a complex topic. In this video, I hope to bring simplicity to this decision by describing the 7 filters that enable you to avoid unwise choices and to make an informed buying decision. This is not an easy subject. The terminology is very specific, and there are very few sources of independent material. We'll discuss the most common questions and concerns expressed by the hundreds of residents and fellows we've worked with as they investigated and acquired disability insurance. By the way, with your permission, I'm going to use the term resident from now on, but all of this information applies to eligible fellows as well. My hope is that by the end of this video, you will have a greater understanding and confidence in 4 areas. What are the criteria for choosing a disability policy? What type of disability contract do I need? What is the process for obtaining it? And what are the next steps in moving forward? So let's begin. There are 7 criteria that are important to understand to make an informed decision. They are 1. How disability insurance companies make decisions. 2. The one-time resident opportunity. 3. The differences between individual disability and group disability. 4. The most important contract terms. 5. The components of cost. 6. The qualification process. And 7. The disability advisory community. First, it's important to understand how income protection is viewed by the insurance companies. The disability industry has a benchmark which limits the policy benefit to about 84% of our after-tax income. Obviously, the insurance companies do not want injured clients to have a greater incentive to remain disabled than to be rehabilitated. So, if you earn $100,000 after taxes, you can safely assume that the best policy will award you about $84,000 a year. From my experience, most practices offer policies which pay out far below this 84% threshold. Let's use a practical, everyday example. Say you're an attending physician with a common group disability plan covering only 60% of your pay, up to a maximum of $10,000 per month. Under this plan, you would lose 40% of your income. That could be catastrophic, so the disability industry allows you to purchase an additional 24%. This additional protection closes the gap between 60 and 84%. One last thing to understand about these insurance carriers. Of the limited number of disability providers in today's marketplace, only a handful are actively involved with medical professionals. We continually research this topic on your behalf, and we've discovered some terrific incentives for eligible residents. This leads me to the next point, the resident opportunity. As I just explained, the disability industry does not really want any of us to be insured for more than about 84% of our net income. There are very specific exceptions, however, for medical residents. Right now, you have a one-time opportunity to potentially stack your benefits past the 84% limitation. Certain disability carriers have created a unique formula for residents which may allow you to purchase disability coverage that actually exceeds your current gross income. The bottom line is this. You may be able to insure in excess of 100% of your starting pay, but only if you take advantage of one of these programs before you finish your training. Take a look at this example. Here we have a first-year physician who starts with $15,000 a month of salary and after taxes earns $97.50. With the group policy that he has in place, this individual has, obviously, 60% of his pay replaced. But look what happens if we take advantage of one of these opportunities through an eligible resident or fellowship program. In this case, you can actually insure up to 111% of your pay. It's important for you to understand that this option has to be taken advantage of before you complete your training and really before you sign a contract with your future group. For most of you, this represents a once-in-a-career opportunity. Now, let's compare individual to group disability. Given the previous information, I think it will be helpful to provide a brief comparison of the most critical elements of individual disability insurance and group long-term disability, which is an employee benefit. First, individual disability is a specific monthly benefit, for example, $5,000, which stays constant regardless of your income. Group disability replaces a percentage of your pay at the time you become disabled up to a maximum monthly amount. For example, if your plan provides 60% of your pay and your monthly salary is $15,000, you would receive $9,000 in disability compensation. Unfortunately, the maximum for some plans is much lower than that. A second distinction concerns taxes. The monthly premium for your group disability plan is commonly paid for by your employer, so any benefits would be taxable. On the contrary, individual disability income is paid by you using after-tax dollars. Therefore, any benefits received would be considered tax-free income. Third, in addition to the taxation and benefit formula, most group plans pay a fixed amount while individual plans can adjust for inflation. Be sure your individual disability contract contains an inflation protector, which allows your benefit to increase each year, ensuring financial stability over a long time. And finally, you want a policy that protects your own specialty. The most comprehensive plans consider you totally disabled if you cannot practice in your own specialty. However, most group disability plans consider you disabled if you are unable to work in your specialty and are not working in another occupation. The reality is that most disability plans will only pay you if you're unable to work at any occupation. No one wants to be forced out of medicine because an insurance company refuses to pay any more benefits. Let's move on to the terms found in an individual contract. Naturally, each individual insurance company wants your business. Their materials can be difficult to decipher, making a comparative analysis challenging. You should begin by thinking about what range of injury or illness could prevent you from continuing in your particular specialty. Are you more concerned about the fine motor skills needed to perform surgical procedures, or do you really only care about cognitive function and basic mobility? In general, I recommend purchasing a contract that has a permanent, specialty-specific definition of disability. As an example, a client of mine has a significant degenerative spine condition that prevents him from being able to practice in his specialty. After several years of being bound to a chair, he developed an alternative business model which pays him well. However, he continues to receive full benefits under his disability contract because he cannot work in his specialty. Consider what you might do in similar circumstances. Perhaps you would choose to teach medical students in an academic setting, or maybe retrain in a similar specialty. Regardless, I believe you should have the maximum amount of flexibility and income potential during such times, and a specialty-specific plan is the most comprehensive definition that the industry offers. Once you have your definition of total disability secured, it's also important to understand the term residual disability. This simply means that if you go back to work in your own specialty, you will continue to receive an income. Without a residual clause, the simple fact that you return to work in your own occupation could disqualify you from receiving further benefits. In addition to the definition of disability, you should consider a plan that offers a cost of living adjustment which provides for an annual increase in your benefit. Look for one that compounds the increase with no monthly maximum. The final term to understand is a provision commonly called a guaranteed insurability, or sometimes a future income protection rider. This is very important for residents to understand. This provision allows you to pre-qualify medically for much more benefit than you're actually purchasing today. For example, if you obtain a $5,000 benefit as a resident that has $10,000 of future purchasability, you can ultimately increase your policy up to a total of $15,000 just by providing financial justification. There will be no further medical qualification. As age often brings more complicated medical history, this ability allows you to pre-insure your future income and also ensures that you ultimately control the terms of your insurance rather than an insurance company or even your own medical health. By applying this set of criteria to the contracts offered by each insurance company, we are able to filter out the contracts that are inappropriate first and ultimately refine a recommendation based on the specific criteria that apply to your unique situation. Of course, no one company has the best solution for all specialties, so be sure your representative offers you a comparative analysis. Okay, so having said all of that, if you're in the same position as most residents, cost is a significant factor in the decision. So how do you know that you're getting the best value for your premium dollar? An understanding of the components of cost will probably be helpful to you. In most circumstances, the components of cost are going to be your age, your gender, your specialty, whether it's invasive or non-invasive, and the amount of the benefit that you obtain. There are other factors, of course, but these are the big ones. Disability carriers consider females to be a higher risk than males. Therefore, females of the same age, health, and specialty will pay more than their male counterparts. And surgical specialists pay more than non-surgical specialists. To reduce cost, here are two strategies to consider. The first is to form a group. Several of the disability companies offer significant discounts if multiple residents enroll within the same department or even the same GME. This could mean a 10% reduction for males and as much as 40% off for surgical females. So it definitely pays to explore this option. If a discounted plan cannot be established, consider a payment structure that increases over time. One nice benefit to obtaining disability while young and healthy is that the amount you pay for your plan can be locked in for your entire career. But that's not much of a benefit if you can't afford the premium. So in recognition, some companies offer a graded premium structure that reduces the initial cost, in some cases as much as 65%, and gradually increases the amount each year. This is not a good long-term strategy, but it can allow you to get through training with affordable premiums and then convert them to a higher level payment plan once your income is increased and your finances are more stable. So, with all this information, how do you obtain disability insurance? There are some common elements to qualifying for coverage. Each company will have their own set of forms that will need to be completed that document your personal and professional information, as well as your medical history. These forms are used by the insurance company to determine if medical records should be ordered for review or if the client has unusual risk factors. You will also need to have a brief medical exam completed. This is arranged and paid for by the insurance company and involves a nurse coming to your home to do a fasting blood draw, obtain a urine specimen, and do a basic paramedical assessment. The sum of these qualification steps are referred to as the underwriting process by the insurance industry, which is really no different than saying the qualification process. All of the collected information is then reviewed by the chosen company, who either makes an offer to cover you or declines for specific reasons. Now, who should you work with? My advice to you is that you work with an advisor who represents multiple companies and is able to guide you through a logical decision-making process. The advisor should be able to assist you in obtaining whichever contract is the most appropriate. This will require an uncommon understanding of the field of professional medicine, the disability industry, and certainly the unique set of circumstances and opportunities that are present with residents and fellows. Chances are, if the person you talk to does not understand what the term PGY stands for, you may want to speak with someone else. Unfortunately, many financial advisors just don't understand the unique characteristics of disability insurance for residents. This concludes our explanation of the disability filter. I hope you find the information useful and informative, regardless of how you proceed. If you would like to pursue a professional relationship with me, please fill in the 2-minute disability survey, which is accessible by clicking the button on your screen. Completing this short questionnaire will provide me with everything that our office needs to make a specific recommendation. That will be our signal that you are interested in developing a professional relationship. Thank you for your time.